Hi, I'm Bianca Barlow from InvestorStream. Today we will be looking at the broad-reaching impacts on global markets caused by China's reopening. The reopening is presenting investors with lesser-known opportunities that extend beyond the traditional focus of mining and resource sectors. China is well recognised as the world's largest importer of iron ore. However, it is also the world's biggest e-commerce market. This provides a clear opportunity for investors to capitalise on the dual drivers of a $2.78 trillion addressable online market and the escalating rise in consumer spending stemming from a record $2.6 trillion in savings that has accumulated during the country's lengthy lockdowns. This opportunity is highlighted by Morgan Stanley Chief Asia Strategist Jonathan Garner's position that pent-up demand will result in a surge in consumer revenge spending that will even outshine the gains made in commodities. Additionally, although China's e-commerce market is already the largest in the world, it is also forecast to grow at an annual growth rate of 21%. A particular area of growth is in the health and wellbeing sectors. Bell Potter's Mark Patterson has a strong focus on macroeconomics in China, as well as broad networks in the region.
I think the outlook for China's demand is very strong at the moment. Obviously, we've come out from a 2-year strict lockdown from COVID, and obviously they're a year behind the rest of the world coming out of these restrictions. The government has cut their reserve requirement ratio, which is equal to the interest rates there, and seem to be the only country around the world that are actually cutting interest rates to stimulate the economy. So with that combined with a reopening, I think the outlook looks really positive and strong for this year.
The PMI data that was released in February demonstrated an 11-year high, indicating a faster than expected economic recovery.
I think there's a lot of saber rattling between the nations, specifically between China and the US at the moment. I think this will blow over, obviously, with Xi Jinping's current visit to Russia. It's all over the headlines. But if you actually have a look at the numbers, McKinsey put out a report last year that indicated there's going to be 400 million households that have medium to upper end incomes by 2030. That is equivalent to Europe and US households combined. So the buying power and the consumption over the next 10 years looks incredibly strong.
The data around buying power is particularly interesting for investors in the consumer sector. These current market conditions present the ultimate scenario for an Australian company that has outperformed its peers during challenging times and has now strategically positioned itself for further advancements. E-commerce company RLG has direct access to Chinese consumers with established channels that include online and offline sales through retail giants such as Aldi, Alibaba and Jebsen Group. It also has a focus on health and wellbeing products and has recently launched its own health and wellbeing range that provides higher margins to drive further revenue growth. An example of RLG's reach is the company's recent announcement to stock and supply remedy drinks into Alibaba's 300 Fresh Depot supermarkets. Given RLG generates revenue from digital marketing annuities and sales of client products, this is a massive achievement for the company. The deal is akin to securing Coles and Woolworths distribution, but with a market the size of China. Recent data also demonstrates that although e-commerce remains the leader for growth, there is also a diminishing gap between online and retail sales. RLG's diversified channels, which cover physical stores as well as online mediums, ensure that the company can quickly respond to these ongoing changes in demand between the two channels and maximise sales at every point of flux in the market. With the company's established foothold and a number of other deals in the pipeline, the outlook for RLG is considered strong, and InvestorStream will continue to track developments in the company.